Hi everyone, in this video we're going to go through our accounting cycle. And in an accounting cycle we do daily journal entries, adjusting journal entries, financial statements, and closing statements, which is a process that happens every month. In this first video we're going to go through daily journal entries, which are on our screen right here, and then make our very first unadjusted trial balance. After this video we will do adjusting entries and its trial balance, financial statements, and finally our closing entries and post-close trial balance. Alright, so in this company, it says that we are creating a new travel agency and we have these following transactions during our very first month of operations. So before we even begin, when it says it's our very first month, that means all of our balances are starting at 0. So we don't have any opening balance in this situation. Every single account is starting brand new and fresh at 0 in this very first month of operations, which is really important when it comes to our company's retained earnings. All right, so now let's go and read through these transactions. We'll put them in our journal and then also in our ledger. So first of all, on April 2nd, it says Nozomi invested $30,000 cash and a computer equipment worth $20,000 into our company in exchange for common stock. So let's step back a little bit and see what we're handling. So here we do have cash, which is an asset. We do have computer equipment, also an asset. And in exchange we have common stock, which is the main form of ownership, that's equity. So all of these things are going up. Assets will be going up, that's our debits. So we have 2 debits. In exchange for common stock, that's a credit balance account, so that will be our credit. Okay, over here in my journal, my first line is going to be cash, which is our asset going up. Then I also have a second asset in this one, which is computer equipment. It's also an asset going up. And then I have my common stock. Common stock is my ownership account. It's an equity account, and it goes up with credits, which is what we're doing here on this last line of the journal entry. Now we need to fill in the amounts. Cash was a total of $30,000. Our computer equipment was a total of $20,000. And then our common stock, it doesn't tell us, but it's going to receive the value of all the assets that were donated and given over to the company, which is the sum of both the lines above of $50,000. Now next in our journal entry process is typically posting these into what we call either T accounts or a ledger. And in this problem we're using ledger accounts, so we're going to move over to the next area and put these into our ledger as we go along, which is what you would do in a real accounting cycle process. Someone would enter this and another accountant would review it. If they approve, it posts into our ledger accounts. So let's go through that as well. Alright, these are the ledger accounts that we use, and every journal entry also gets written into our ledgers. And so we're going to need to put the information that we have in a journal entry into our ledger. So I'm going to fill them in real quick. Alright, so if you can see that on April 2nd, I've filled in our cash balance for $30,000 in the debit column. That corresponds to my journal entry. I've filled in computer equipment for $20,000. That also corresponds to my journal entry. And I've got my common stock for $50,000. Now these are set up as ledger accounts, which means I also keep a running balance just on the side as well. All right, I've got all my balances ready to go, and I'm going to go back over to my next journal entry. All right, next up it says on April 4th, the company purchased $1,000 of office supplies, and they used cash to do that. So let's put that in our journal entry next. All right, so my first line in my journal entry is going to be office supplies. This is an asset account that's going up, and then I'll need a debit to do that. And then I have cash. I'm using cash. This is an asset account that's going down, and I'll need a credit to make that happen. And the dollar amount for these is $1,000. So again, I'm purchasing office supplies for my company, an asset going up. I'm using cash, an asset going down. Now we're going to move over and put these into our general ledger as well. All right, so now I've brought over my journal entry and I've put in on April 4th for my cash, You see a credit of $1,000, which brings my cash balance down to $29,000. And then I've also filled in my office supplies that I purchased as a debit with a total balance now of $1,000. All right, in my next journal entry, it's now April 10th, and my company is paying $2,400 cash for a 12-month insurance policy. So here I do have cash, which is an asset going down, and I have an asset going up known as a prepaid. This is a policy I'm paying for in advance, and I'll use it over time. It's a prepaid insurance policy. All right, so I'm putting this in my journal. Prepaid insurance is my asset. It's going up, and that's going to be my debit. And my credit is cash. I'm using cash to buy this policy, and it's valued at $2,400. I'm also going to need to put this into my ledger as well. All right, now I've brought this journal entry over. On April 10th, I see that my cash is going down by $2,400, and I have an updated balance there. And then I also now show prepaid insurance has a balance of $2,400, which will be used over the next 12 months. All right, now on April 14th, it says I pay cash for 2 weeks' salary earned by my employees. And this is going to be salaries expense and cash. So salaries expense is an expense going up. That'll be my debit line. And cash, our asset going down, will be my credit. So let's put that in our journal entry. All right, so I've got my two accounts. Salaries expense is an expense that's increasing. That's going to be my debit line. And it said it was $1,600. They're being paid right now with cash. So cash is going down $1,600. And I'm also next going to put this into my ledger account as well. All right, so my first part of my journal entry is my cash impact I'm putting on here. My credit piece is bringing my cash balance down. All right, now I've also entered my salaries expense for $1,600. All right, next up is April 24th, and it says our company collected $8,000 in cash for commissions revenue, which in this company is their primary form of business. All right, so here, this time my very first line is going to be cash. Cash is an asset that's going up this time, going up by $8,000. And then my credit is my revenue account. It's my main line of business, and it's increasing equity, goes up with a credit, and I've got $8,000. Let's also put this in our ledger. All right, so I've got my debit here, cash increasing by $8,000. And then a little further down, I've also got my commissions revenue increasing with the credit and a total balance of $8,000. All right, in my very last entry for now, I've got paying $1,500 cash and dividends. Now, remember, dividends is how we return money to our owners. And it has a normal debit balance, which means it increases with debit. So let's go put that in our journal. All right, so here I'm going to have my dividends. This is how I pay my owners. It goes up with debits, and I'm using cash to do that, which is my credit. So let's also put this in our ledger. All right, so I've added my line for my cash decreasing for my dividend payment. And then a little further down, I've also put my dividends. It's a debit balance, so it's going to go on the debit side. Now at this point, all of my journal entries for my normal transactions during the month are 100% totally complete. The last thing I need to do as part of this part of my accounting cycle is I need to make a trial balance. If you think about when these accounting records were done by hand, it's easy to make a mistake. A trial balance takes our ending balance, whether we're looking at ledgers or T accounts, and moves it into just a listing to make sure that all of our debits and all of our credits are equal. So we're just going to look at every single account and line it up, make sure all our debits equals all our credits. All right, so what I've done is at this point in time, I've just brought over every single account's balance for right now. Typically in a trial balance, we start with assets. Cash is our first asset. Then we look at any liabilities and then our equity accounts. So I've, again, just brought every single balance over, and I'm going to sum up all of my debits, and I should get the same number on both sides, all my debits and all my credits. And in this case, $58,000 would be the total of both. If I don't get the same number here, then I need to go back and find out somewhere I made a mistake. So again, always your total debits, balances in your account should equal your total credits. And this is the end of our first part of the accounting cycle where we do our normal, everyday, daily transactions.